Oh, here's the question we'll tackle today. Can you contribute to a solo 401k and a Roth IRA in the same year? The short answer is yes, in many cases, but there are IRS rules, income limits, and strategy choices that you need to know. We'll cover how these accounts interact, contribution limits, and why pairing them could be the ultimate retirement power play. Please also type over your questions during today's webinar, and we'll pause and answer those questions as they come in. They don't have to be specific to today's topic. Please also like today's video to help get the word out to other solopreneurs like yourself. Also, subscribe to our channel so that you receive notifications when we go live. We have a large video library on our YouTube channel, over 900 videos. We also have our community section of our website. It's free to join. And then we also have the artificial intelligence, which is solo401k.ai. Take a look at that as well. Looks like we've got some questions here. Alfonso, I just opened my solo 401k account. Can you detail the process to inform you guys about contributions made from both the employee side and the business side? Are there forms you fill out? Any integration with payroll providers like gusto.com? So number one, the contributions to the solo 401k plan will flow directly into the solo 401k holding accounts, whether it's a bank account or a brokerage account that you use to hold the solo 401k funds. Number two, the contributions are not reported to us. Instead, those contributions are reported on your business tax return and possibly your personal tax return. I'm going to provide a link to our website that details how to report contributions for the solo 401k. Give me a moment here and I'll provide that link. So again, they are not reported to us. Instead, those contributions flow directly into the solo 401k bank or brokerage accounts. For example, if you used Fidelity for the brokerage accounts, you would have separate brokerage accounts for those source of funds. You would make the contributions into those respective brokerage accounts. So that's how they are tracked. And then B, you further report those contributions to the government when you file your personal and or business tax return. And let me provide a cheat sheet here that talks about how to report contributions. Let me provide a link here. If you take a look at the link I just typed over, you're going to see that that links to a good page on our website that has detailed graphics of how to report contributions on your personal and or business tax return. Yes, contributions to the solo 401k plan can be integrated with your Gusto payroll provider. Let me send over a link to do that. So here's a link from our website that talks about integrating contributions through your payroll provider like Gusto, so that you can do those contributions to the solo 401k. We'll take a look at that. And again, when you open a solo 401k plan, you're going to have separate holding accounts for each source of funds, including for each participant. So here's an example of a one participant plan. So let's say your business is taxed as an S corporation, and that's your self-employed business, and it's just you in the plan. You would have 3 separate brokerage accounts at Fidelity, for example, if you use Fidelity to hold the solo 401k funds for the plan that we provide. So you would have one brokerage account labeled pre-tax, the second one labeled Roth, and the third one labeled voluntary after tax. Here's an example of a 2 participant plan. Let's say you and your spouse are both working under the same self-employed business. Let's say your self-employed business is an LLC, taxed as an S corporation. The LLC would sponsor the plan, so just one solo 401k plan. Each spouse would have separate holding accounts because a solo 401k is a defined contribution plan. As a result, you are required to separately track each participant's and source of funds. So that's why this image here shows a total of 6 brokerage accounts or bank accounts, depending on where you used to hold the funds. When you open a solo 401k with my solo 401k financial, you get to decide where to hold the money at. Many of our clients use Fidelity or Schwab to hold their funds for the plan. So this is an example of 6 brokerage accounts. So 3 for each participant, because each participant has Roth, pre-tax, and voluntary after-tax in the plan. Okay, so again, go ahead and type over your questions during today's daily webinar. We'll go over those as they come in. Looks like we have another question here. When taking a loan against one solo 401k, are early payments to pay back that loan possible? If so, what happens if payments are made early? Will it change the principal interest and interest scheduled and consequently the payback period? For example, assume I take a $50,000 loan from the solo 401k that needs to be paid back in 5 years. What happens if I make additional payments? Will that work similar to how the schedule and allocations of payments, the principal and interest portion? Great question. So number one, yes, you can borrow from the solo 401k plan. That's known as a 401k participant loan. You can borrow 50% of your total balance not to exceed $50,000. So for example, if the balance of your solo 401k is $100,000 or more, then you can borrow $50,000. That would be the maximum. On the other hand, if the balance of your solo 401k is $80,000, the maximum you could borrow is $40,000. Keep in mind that that loan amount threshold applies to each participant. So for example, if you and your spouse are both self-employed and participate under the same solo 401k plan, you can each borrow from the solo 401k plan based on your respective funds from the plan. So if let's say Jane has funds in the plan and Jack also has funds in the plan, Jane could borrow 50% of her solo 401k balance. So based on her respective funds in the plan. And then Jack could also borrow 50% of his respective balance. But you cannot piggyback off of each other's funds. You can borrow off your respective funds in the plan. So if you each have enough funds in the plan, you could each conceivably borrow $50,000 from the plan for a total of $100,000. So that's number one. Number two, yes, you can pay a loan back early. There are no prepayment penalties when paying a back loan early. Keep in mind when making solo 401k loan payments, you have to make periodic payments to that loan, either monthly or quarterly based on the payment schedule. In other words, the full payment is not due in 5 years, but rather you have to make scheduled payments monthly or quarterly during that 5-year period. Now, yes, you can pay the loan back early, but paying the back loan early doesn't mean you're going to be able to borrow again from the solo 401k right away. The IRS has a regulation known as the 12-month rule to keep individuals from churning solo 401k participant loans. So therefore, let's say you borrow the full $50,000 and you pay it back early within, let's say, 6 months. You're not going to be able to borrow from that solo 401k plan again until 12 months later. So keep in mind we're paying a loan back early. Also, if you make additional payments to the loan, so you make payments over the scheduled payment amount, that doesn't mean that you still don't have to make your next scheduled quarterly payment. What that means is that you're paying the loan back sooner. So you're going to want to make sure that if you pay that back by the 5-year period, that you don't overpay on your loan. So not only are you not allowed to underpay a loan, you're also not allowed to overpay a loan. So those are the rules you need to be aware of. To learn more about the solo 401k participant loan rules, you can visit our website. We also have a large video catalog on our YouTube channel, and we've done many videos regarding solo 401k participant loans. So take a look at our YouTube channel. I just also shared a link to a page from our website that talks extensively about the loan regulations, and there's a video on that page as well. And again, you can also visit our YouTube channel to access other webinars that we've done on this topic before. So here's our YouTube channel here. You can get to it by this address here. You can subscribe to that channel for more videos like this. Also take a look at our community page. Also take a look at our Solo 401k AI, which is www.solo401k.ai. Okay, let's take a look at some information here on today's topic, and we'll come back and look at some more questions. So today's topic is, can I have both a solo 401k and a Roth IRA? So obviously the answer is yes. At least it's obvious to us, so not to everybody, but let's talk about that in more detail and go ahead and shoot over any questions you have regarding solo 401ks, self-directed IRAs, the rollover business startup 401k, and even traditional 401ks. Doesn't have to be specific to today's topic, and we'll answer those questions as they come in. So here's what we are going to unpack today. We're going to talk about the basics. What makes a solo 401k different from a Roth IRA, for example? The contribution rules, how much you can put into each, and when the IRS says too much. Smart strategies, how using both accounts together can give you tax flexibility, pre-tax deductions today, tax-free growth tomorrow. Pitfalls to avoid, common mistakes that self-employed individuals make when trying to juggle multiple retirement accounts. So let's take a look at the next slide here. So the big question, can you contribute to a solo 401k and a Roth IRA in the same year? Yes, you can. So obviously, just like everything else with the IRS, you have to make sure you follow certain regulations. So number one, you have to qualify to open a solo 401k plan, obviously. Who qualifies to open a solo 401k plan? Well, a solo 401k plan is for owner-only businesses that do not employ any non-owner full-time W-2 employees who work 1,000 hours or more. What that means is that as long as you don't employ someone who is not an owner in your business who works 1,000 hours or more as a W-2 employee, then you can open a solo 401k plan. That same rule extends across other businesses that you own. So if you also own other businesses and you're a majority owner, and any of those businesses employ a full-time non-owner W-2 employee who works 1,000 hours or more, that would preclude you from opening a solo 401k plan for the business where it's just you. That's referred to as the control group regulations, affiliated service group regulations. So there's a spousal exception, of course. If your spouse also works in the same business, then he or she can also participate in the plan, even if he or she is a W-2 employee and is not an owner in the business. So don't confuse that rule. Many of our clients participate in the same solo 401k because they're married and they both work in the same business. So that would result in one plan for both spouses. And we shared an image earlier of an example of the plan where you would have two participants in the plan. Here's that slide here. So two participants, both spouses participate in the same business or work in the same business, I should say. So one plan, the plan would be sponsored by the business, and each spouse can participate in the same plan. They would have separate holding accounts under the plan. So not two plans, just one plan. Now, to open an IRA, you don't have to be self-employed. So with an IRA, which stands for an individual retirement account, that type of account, you're not required to be self-employed. However, if you want to make annual contributions to a Roth IRA based on your earned income, you're going to have to make sure that you have wages, whether it's W-2 wages or earned income from your self-employed business in order to contribute to a Roth IRA. Also, when making contributions to a Roth IRA, you have to make sure that your modified adjusted gross income is not over a certain limit. Because if it is, then you will not be able to make Roth IRA contributions. However, even if you make over a certain amount above your modified adjusted gross income, you can still open what's referred to as a non-deductible IRA and make a non-deductible IRA contribution and then convert that to the Roth IRA. That's known as a backdoor Roth IRA. Don't confuse the backdoor Roth IRA with the mega backdoor Roth solo 401k. They're different. And actually, our clients utilize both strategies as well. The Roth IRA contribution limits are $7,000 for tax year 2025. If you're over age 50, you can contribute $8,000. Same thing with the non-deductible IRA. It's $8,000 if you're over age 50. If you're under age 50, it's $7,000. Keep in mind, when making contributions to IRAs, you have to aggregate that annual contribution limit between all your IRAs. In other words, you can't contribute $7,000 to your traditional IRA and then another $7,000 to your Roth IRA. It's aggregated. So you can contribute the full $7,000 to a Roth IRA, or you can contribute some to a traditional IRA and some to a Roth IRA. But again, traditional IRAs are also subject to the modified adjusted gross income rules as well, especially if you're also participating in a solo 401k. With the solo 401k, the annual contribution limit for tax year 2025 is $70,000. If you're over age 50, you can contribute an additional $7,500. If you're age 60, 61, 62, or 63, instead of contributing that catch-up amount of $7,500, known as the normal catch-up contribution, you can contribute a super catch-up contribution of $11,250. So that's on top of that $70,000 annual contribution. So as far as today's topic, please go ahead and shoot over your questions, and we'll go ahead and pause and answer those questions as they come in. It looks like we've got some more questions here, so let's pause and take a look at those questions, and then we'll come back and continue with today's topic, which is, can I have both a solo 401k and a Roth IRA? So we've got a question here from Alfonso. When paying back the solo 401k participant loan, is it done financial institution where the account is held? How is that reporting done? Great question. But you're exactly right. When making loan payments on that solo 401k participant loan, those payments are deposited to the holding account for the solo 401k. So again, many of our clients use Fidelity investments to hold their solo 401k funds for the plan that we provide. And it's our plan that allows for the solo 401k participant loan. So when making a loan payment to that brokerage account at Fidelity for the solo 401k that you opened with my solo 401k financial, for example, once you process that solo 401k participant loan, you got to start making payments either monthly or quarterly, and they're scheduled payments. So you can make those payments by check, or you can make them electronically via ACH, where you link your personal bank account to that brokerage account at Fidelity for the solo 401k, and that's where the payments flow into. That's where the loan payments flow into. So you would make those payments with funds from your personal bank account, so not funds from the business, because the loan is to you. You're borrowing from the plan, and to satisfy the solo 401k participant loan rules, not only do the loan proceeds flow to your personal bank account, but the payments on that loan have to be made from personal funds, not business funds or solo 401k funds. Let me send over a link from our website that talks about how to make those loan payments if you utilize Fidelity Investments to hold those funds. And you're going to see instructions there of how to make that loan electronically by linking your personal bank account to that Fidelity brokerage account. There's the link there. You can also do it by check, but it's going to be much easier if you link your personal bank account, and you're going to do that on your personal bank side. So you'll log into your personal bank account and you're going to link that bank account to the Fidelity brokerage account. You'll provide Fidelity's routing number and your account number. You'll enter that on the bank side of your personal bank account. And that link I just shared has a link that has instructions on how to do that. So take a look at this link here that I just shared with you. If you utilize Fidelity or the Solo 401k that we offer here at my Solo 401k Financial. Okay, let's see if we have any other questions for now. Got another question here. Loans seem to be a hot topic today. Are there limits to the number of loans you can take out of your Solo 401k? Can you have 2 loans at the same time? Great question. So yes, you can borrow from the plan multiple times. You can have multiple loans, but you cannot exceed that overall loan limit and aggregate between all your loans. Also, keep in mind that if you have multiple loans, you're going to have separate payment schedules drawn up. So you're going to have to make sure to keep track of those payments, that you make those payments timely. So you're going to have to juggle multiple loans. For that reason, I don't recommend processing multiple loans because, again, you can't borrow over that percentage amount, which is 50% of your total 401k balance, not to exceed $50,000. So the maximum would be 50,000 aggregated between all your loans. So let's say the balance of your solo 401k is $150,000. Let's say you borrow from the plan today, you borrow $25,000, and then you turn around and borrow some more in 3 months. You can borrow another $25,000 at that time. Now you're going to have 2 separate loans outstanding at one time, so 2 separate payment schedules, and you will have maximized the amount you can borrow. Likewise, there's a 12-month rule that applies. If you pay one loan back early, you're going to have to wait 12 months to be able to borrow the full $25,000 again. There's a calculation that has to be performed. And that's put in place to keep individuals from using their solo 401k as a piggy bank. All right, good question. Let's see what other questions we have here. Got a question from Catherine. Let's see that question here. I'm getting confused on the type of solo 401k offered. My understanding is there are 2 options. One's a Roth solo, post-tax contributions, and the other is a traditional solo 401k pre-tax contribution. Is that correct? Good question, and no, that is not correct. Let's take a look at this slide here to help clarify and paint a picture for you. So it's only considered one solo 401k plan. It's the solo 401k plan itself that allows for various contribution types. It allows for pre-tax employee contributions, pre-tax employer contributions, employee Roth solo 401k contributions, and or employer Roth solo 401k contributions, and voluntary after-tax solo 401k contributions. So the plan itself allows for these various contribution types. Now, keep in mind that not all solo 401k providers allow for voluntary after-tax solo 401k contributions. For example, Fidelity and Schwab do not allow for after-tax solo 401k contributions, known as voluntary after-tax solo 401k contributions as part of the mega backdoor Roth solo 401k strategy. So when you open a solo 401k plan, these different sources are available from a contribution perspective. You're not required to open up all these separate buckets, aka bank or brokerage accounts, to make these contributions if you do not plan to make these contribution types. But that does not mean that the plan does not allow for it, nor does it mean that later on you can't come back and make the pre-tax contributions or Roth contributions or voluntary after-tax contributions, that would just entail making sure you open up the additional bank or brokerage account, not another plan, but the additional bank or brokerage account to hold these funds. So hopefully that helps paint the picture. It's just one plan, not separate plans. It's the plan that allows for these various contribution types. That's why sometimes you hear the words Roth Solo 401k, pre-tax Solo 401k, Mega Backdoor Roth Solo 401k. At the end of the day, it's considered one plan that allows for these various sources of contributions. Good question. Let's see here if we have any other questions for now. Uh, got another question here, or comment from Catherine. So, as a self-employed, recently married person, congratulations. My accountant told me I can no longer contribute to a Roth IRA. Therefore, I can only contribute to a solo 401k and not have both retirement accounts, correct? No, that's not correct. And I talked about this a little bit earlier. So, contributions to a solo 401k do not impact the contributions that you make to your Roth IRA. What impacts your Roth IRA contributions? It's your modified adjusted gross income. In other words, if you make over a certain dollar amount in wages, then the government does not allow you to make Roth IRA contributions. However, there's a workaround that. That's known as the backdoor Roth IRA. The backdoor Roth IRA gets very complicated, and we've done many webinars on this topic, but at a high level, you would open up an IRA with your current IRA provider. So you would open up a separate IRA, and that would be a non-deductible IRA. You would make your non-deductible IRA contribution into that IRA. So let's say $7,000 for tax year 2025. Obviously, you would not get a deduction for that contribution because it's a non-deductible IRA contribution. Now, assuming you don't have any other IRAs or any SEP IRAs or simple IRAs, you would turn around immediately and convert that non-deductible IRA contribution to a Roth IRA. So that's why it's called a backdoor Roth IRA, because you get to the same place by utilizing that extra step, opening up that non-deductible IRA and then converting it to the Roth IRA. Now, again, if you have other IRAs already, or simple IRAs or SEP IRAs, then that's going to throw a wrinkle into your backdoor Roth IRA strategy. But there's a solution for that. You could actually transfer that SEP IRA and those traditional IRAs to the pre-tax solo 401k to isolate those non-deductible IRA contributions, and then turn around and make that non-deductible IRA contribution and convert it to the Roth IRA. Now, if you have an existing non-deductible IRA already that's got basis and gains, you could also transfer the gains in that non-deductible IRA to the pre-tax solo 401k, and then turn around and convert that non-deductible IRA to the Roth IRA, the non-deductible IRA to the Roth IRA. We did a webinar on this last week, so take a look at our YouTube channel again so that you can view our video catalog where we have over 900 videos so that you can learn more about this particular topic. Let me share that. Here it is. You can go to our website, our YouTube channel, and you can download that webinar we did last week about isolating your IRAs so that you can do a backdoor Roth IRA. Now, don't confuse the backdoor Roth IRA with the Mega Backdoor Roth Solo 401k, as I mentioned earlier. The Mega Backdoor Roth Solo 401k is a whole other strategy that is now subject to the pro rata rule. Okay, so let's see here. What other questions we have here? Looks like Alfonso is back with another question here. You mentioned a Mega Backdoor Roth IRA and a Roth IRA. What's the difference? Well, I just kind of talked about the difference. The make it back to a Roth IRA is when you make a non-deductible IRA contribution because your modified adjusted gross income is too high, and therefore you cannot make a Roth IRA contribution, but you utilize the non-deductible IRA to get around that regulation. So you would make a non-deductible IRA contribution and then convert that to the Roth IRA. That's referred to as a backdoor Roth IRA. Then there's the mega backdoor Roth solo 401k. There's no such thing as a mega backdoor Roth IRA. It's called a backdoor Roth IRA, but there is such thing as the mega backdoor Roth solo 401k. The mega backdoor Roth solo 401k is where you make a contribution to the voluntary after-tax solo 401k holding account. So you make it into this bucket right here. And you can contribute a total of $70,000 as a voluntary after-tax solo 401k contribution as part of the overall limit for tax year 2025. That would be made directly to the voluntary after-tax solo 401k bucket. So that's $70,000. And then you would turn around and convert that to the Roth solo 401k. That's called the mega backdoor Roth solo 401k. You can also choose to convert that voluntary after-tax solo 401k contribution that you make to the solo 401k to the Roth IRA instead if you want. But it's still referred to as the mega backdoor Roth solo 401k. Okay, let's see here. Go ahead and continue typing your questions during today's daily webinar, and we'll come back and go over those questions as they come in. Meanwhile, let's pick back up here. We're talking about today's main topic is, can I have both a solo 401k and a Roth IRA? We already talked about these first two items here. We've kind of talked about these smart strategies and tax flexibility, but let's talk about it some more. So when you contribute to a solo 401k plan, you can also contribute to a Roth IRA. So for example, for tax year 2025, the overall contribution limit to a solo 401k is $70,000 for those who are under age 50. If you want to also contribute to a Roth IRA, as I've already touched on earlier, as long as your modified adjusted gross income is under a certain limit, you can also make your full Roth IRA contribution, which is $7,000 for tax year 2025 for those who are under age 50. Let me see if I can pull up a good page from our website regarding the modified adjusted gross income regulations that apply to a Roth IRA. Give me a moment here. Okay, let's see if I can share my screen. Give me a moment here. It's from our website regarding contributing to both a solo 401k and a Roth IRA for tax year 2025. So we've already talked about the annual contribution limits to an IRA, to a Roth IRA for tax year 2025. It's $7,000 for those under age 50, $8,000 for those age 50 or older. So again, I've talked about the modified adjusted gross income, which in layman's terms, it means your salary, how much earned income, including W-2 wages you make for the year. If it's over a certain dollar amount, then you will not be able to contribute to a Roth IRA. But if it's under a certain dollar amount, then you can do the full Roth IRA contribution. Well, here's a good chart here that goes over those limits. It talks about it from with respect to someone who's married versus someone who's not married. So take a look at this chart here. Got some good information about those limits. So obviously, if you see one here that one labeled married filing separately, if your modified adjusted gross income is greater than $10,000, then you will not be able to make any Roth IRA contributions. If you are married and you file a joint tax return, then you can make a Roth IRA contribution as long as your modified adjusted gross income falls within this limit here, that 236, but not over $246,000. So if you make over $246,000 and you file a joint tax return, then you cannot make any Roth IRA contributions. But again, these do not apply to their solo 401k. The Roth solo 401k are not subject to these modified adjusted gross income regulations. And also, there's a way to get around these modified adjusted gross income limitations with making Roth IRA contributions by making a non-deductible IRA contribution instead, and then immediately converting that non-deductible IRA contribution to a Roth IRA, which I talked about in great length earlier. So we talked about the solo 401k contribution limits already. All right, let's check to see if we have any other questions for now, and then we'll continue. Looks like no other questions at the time, so let me go back to sharing my slides here, and we'll continue with today's topic, which is, can I have both a solo 401k and a Roth IRA? Please also like today's video to help get the word out to other solopreneurs like yourself. Please also subscribe to our YouTube channel so that you get notifications as to when we go live. We typically go live at least once a day, many times twice a day. For example, we'll be going live again today in a few hours. So if you don't have a chance to ask your questions now, you can ask them at that time. Let's take a look at the next number here. Pitfalls to avoid. So anytime, and we've kind of been talking about this indirectly. So anytime you're looking to make contributions to both a solo 401k and a Roth IRA, you need to make sure you understand the various rules that apply. We talked about already at great length regarding Roth IRA contributions, how they're subject to the modified adjusted gross income, meaning if you make over a certain amount in W-2 wages and or earned income, then you cannot contribute to the Roth IRA. But there's a solution for that. You could utilize the backdoor Roth IRA. And also, if you want to contribute to the solo 401k plan, you need to make sure you have self-employment income in order to contribute to that solo 401k, because a solo 401k plan is for those who are self-employed. And in order to make a contribution to a solo 401k plan, whether it's a pre-tax, Roth, or voluntary after-tax solo 401k contribution, you have to have the necessary earned income from self-employment income to support that contribution. So those are pitfalls to avoid. Also, while we're at it, just make sure you understand that you can never transfer a Roth IRA to the Roth solo 401k. You can go from a Roth solo 401k to a Roth IRA, provided you meet certain triggering events like age 59 and a half or no longer self-employed, but you can never transfer a Roth IRA to the Roth solo 401k. That's a Roth IRA regulation. We already gave some real-world examples regarding contributing to both a Roth IRA and a solo 401k. Let's do another example here. Let's say that Janet and Bill are self-employed under the same self-employed business. Let's say it's an S corporation. So Janet and Bill decide to open a solo 401k plan. So Janet and Bill are going to be able to make contributions to the solo 401k plan based on their respective earned income from self-employment activity. In this case, their self-employed business is an S corporation. So they'll be able to contribute to the solo 401k plan based on their respective W-2 wages from that S corporation self-employed business. Let's say that Bill and Janet each make $100,000 of W-2 wages from their self-employed S corporation. So Jane decides that for tax year 2025, she wants to really supercharge her Roth solo 401k funds. So she decides to execute the mega backdoor Roth solo 401k strategy. So based on $100,000, Jane could contribute, or Janet, I should say, Janet can contribute $70,000 to that voluntary after-tax solo 401k bucket. And then Janet can turn around and convert that to the Roth solo 401k, the full $70,000. Janet's going to want to convert that right away so that there are no gains in that voluntary after-tax solo 401k funds. Because when those gains get converted to the Roth solo 401k, just those gains will be subject to taxes, which it'll be minimal gains if she processes that conversion right away. Let's say that Bill also wants to utilize the mega backdoor Roth solo 401k strategy, and Bill reports $70,000 of W-2 wages from his S corporation self-employed business. And again, both Janet and Bill are both working under the same S corporation, but Bill reports $70,000 of W-2 wages instead of $100,000 of W-2 wages. Bill can contribute that entire $70,000 to the voluntary after-tax solo 401k bucket, because the voluntary after-tax solo 401k calculation is based on a dollar for dollar. It's a dollar for dollar calculation based on the W-2 wages, since the self-employed business is an S corporation. So Bill would contribute that entire $70,000 to the voluntary after-tax solo 401k bucket, and then immediately convert it to the Roth solo 401k. Both Janet and Bill would go to our website if they're our clients, and they would complete our online conversion form so that we collect the necessary information to issue the Form 1099-Rs to report that conversion of the voluntary after-tax solo 401k to the Roth solo 401k as part of the mega backdoor Roth solo 401k strategy. So it'll be reported on a Form 1099-R. They would each receive a separate Form 1099-R because they each process the mega backdoor Roth solo 401k strategy. Okay. So it looks like we're coming to the end of our session today. We appreciate you joining, asking your questions. We'll be live again here in a few hours. Until next time, have a great rest of the day.